Today, CFS meets Celine Piquemal-Prade, manager of the fund Comgest Growth World. Good morning, Celine.
Good morning, Riccardo.
And welcome to Milano.
Thank you.
Just a few questions about your fund. Which macroeconomics factors and which indicators on the main market influence your recent investment strategies?
So this is a very good question. What we understand is that over the long term, when you invest in equities, 70% of the stock the direction of the stock prices will be driven by earnings expansion. So we pay a lot of attention to earnings expansion, and the conclusion we get to today is that we are in an environment without growth. Over the past 4 quarters, we have to remember that earnings have gone down by 7% on a global basis. So basically, this is the main thing we need to look at when we want to invest for the long term as of today. We are in a low growth environment.
So, what are the portfolio drivers that determine your choices and explain the low correlation with the benchmark we have seen in our analysis?
So again, what matters to us is earnings expansion. So we dedicate time at selecting companies that will show earnings expansion, whatever the environment, whatever the economic environment. So we end up with a portfolio made of different companies that have a unique franchise, a unique ability to grow whatever the environment. And today we end up, for example, with 25% of our companies being market share gainers. Those are companies like Don Quixote in Japan that have the ability to expand in retail. Don Quixote is a low-cost player in Japan. They are the equivalent of an Aldi or Lidl, and this company is grabbing market share, which enable them to grow whatever the result of the Abenomics or the environment in Japan. The other big driver we have in our portfolio is the aging population. We have to remember that 33% of the population in 2050 will be in Italy 65 and more. And this is a massive growth driver for companies that we have in our portfolio. So again, it all comes back to selecting companies, which explains why we end up with a portfolio that materially differs from the benchmark.
And there are other 3 possible areas that you take care specifically. Not only the aging population, the market shares, right?
Yep.
I remember the digitalization, the emerging market exposure, and the productivity enhancement. Can you give us some ideas of our different areas?
Yes, this is a very good point. You're right, Riccardo. We have in our portfolio around 20% of our portfolio exposed to the digitalization of our environment. We spend more and more time on Deezer, on Netflix, and this is ultimately a very strong driver for companies like China Mobile that enable you to get access to this data world that we are currently facing. Another good driver is the fact that we invest in companies that enable you to save money. We know that this is a very important problem for the companies today. They want to expand their margins to save money, and they end up using companies like Amadeus, for example, when you're an airline company, that enable you to save money on the IT side, on the software side, as Amadeus will take care of your baggage management, your departure management, and this is very important for us because, again, it enables this company to grow whatever the environment, which is exactly what we look for.
Good. Which are the key points of your long-term strategy and the criteria that determine your possible corrective action? Because we know that the market are not stable, and so.
So basically, we are strong believers in earnings. So we select companies that will grow at a double-digit pace, whatever the environment. And when you look at what we've done over the past few years, we had companies that have been able to deliver 10 to 12% earnings expansion in an environment, again, where you had no growth. And today, we have a portfolio that should expand at a 10% pace in 2016 in an environment where we expect 2 to 3% earnings expansion max. So again, this is what we look for, what we believe in, and when it comes to corrective actions, we know that markets can be bumpy from time to time. We've experienced it last summer in China, for example, but again, Kennedy was saying, in the world crisis, you've got danger and opportunity. For us, when we face big crisis like this is an opportunity, and it enables us to buy companies for the long term.
Compare with its benchmark, the fund in recent months is overweight on the Japanese market, underweight on the US market, absent from financial and energy sector. How do you explain this to our financial advisor that generally takes care of the benchmark?
Yes, this is a very good question, Riccardo. At Comgest, we select companies, not sectors, not geographies. We buy companies with a unique franchise, and we are here to benefit from the opportunities offered by the market. And we know that we always have bumps on the road, which ultimately leads to some inefficiencies. And today, I must confess that we end up having very good and strong franchises listed in Japan or in China, trading at very, very reasonable valuations. And this is why ultimately we had to buy, as disciplined investors, those strong franchises with a lot of growth embedded in them at a very reasonable price in Japan and in China. Going forward, the world might be different. We might end up finding opportunities that would be very attractive in other markets. But today, I must say that this is where we find a lot of opportunities. And this is why we end up with a portfolio that materially differs from the benchmark. But this is nothing we care about. We are here to invest for the long term and to look for the opportunities where they are at a certain point in time to enable our investors to outperform over the long term, which is something that we've been able to deliver over the past 30 years at Comgest.
Thank you very much, Celine, and see you soon in Italy.
Thank you,
also
Riccardo.
for your investments.
Thank you very much.
Thank you.